The analyst coverage of EPAM Systems Inc. was yet another gross display of incompetence. I'm going to tell you how to become a millionaire today. A low-grade millionaire with just like 2 to 3 million in the bank. Nothing crazy. I'll tell you how you could have done it easily over the past decade. Start with $1 billion and trade EPAM stock based on the estimates that Wall Street analysts had given. If you had followed their advice, you'd likely have around $2 to $3 million left. Maybe even less, to be honest. The incompetent analysts we'll cover today not only botched history, but also further proved our point from the last video. In that video on Intel, we noted patterns suggesting that analysts often act more as mere relationship managers for the companies they cover than as objective evaluators. This becomes glaringly obvious when analysts ride a stock all the way up and down, continually adjusting their price targets, but maintaining, for example, a neutral or even worse, a buy call the entire time. We'll show some more charts demonstrating this in a few minutes. Wall Street analysts are supposed to provide unbiased information that investors can use to make sound decisions. However, if you know how it works on the street, you'll likely agree with us that no one should ever rely on these analysts for anything related to investing. Most of the time, they're merely acting as advertisers for the companies they cover, nothing more. If you want to succeed in the investing game, you need to be far removed from all that noise. The noise on Wall Street, whether from brokers, analysts, bankers, or whoever, is often rooted in gross incompetence, mass hysteria, and even worse, salesmanship tainted by the conflicts of interest that we've mentioned and even more. So the smartest move is to be completely removed from it. We'll return to that point in a few minutes. Be sure to like, subscribe, and hit the notifications icon so you're notified accordingly, and continue to tune into Incompetent Capital, where accountability for competence on Wall Street is our #1 priority. EPAM Systems had a hell of a run until 2021 when the stock took a turn for the worse. As you can see from the chart, all of the analysts that we covered followed the same basic pattern of negligence. Our first defendant of the day in our incompetence court, Mayanak Tandon of Needham, played a game of chase with EPAM from 2014 to 2021, making a series of buy calls that were reactive to the stock price. He also made a few slight overbids in the period as the stock began to climb aggressively. Then, in late 2021, he went all in with a whopping 840 buy call. Bold move, Mayanak, but unfortunately for him, the stock began to crash right after that. And again, he played a game of chase, lowering his estimate as the stock trended downwards. Gross incompetence. And on top of that, he continues to secure his position as an unofficial relationship manager for EPAM and Needham. As you can see from the chart, Mayanak maintained a buy holding on this stock all the way down, even to this day. Come on, guys, be a little less obvious about this. Our next culprit for the day, Arvind Ramnani of Piper Sandler, was seemingly playing a game of chase as well. But unfortunately for him, he is busted on 2 counts. 1 count of incompetence and 1 count of copying his friend Mayanak. As you can see from the chart, it seems as though Arvind took a good decade off from work and merely copied Mayanak's numbers and subtracted a few from some of them so as to not be completely obvious about it. Chase it up, overbid at the peak to bankrupt the investors who listen to you all the way up so they don't have money to complain in court, and then finish the rest off with another game of chase all the way down. All the while making overweight buy ratings on the stock the entire time. You can't make this stuff up, guys. It's right on the screen. Absolutely egregious. But everything is good for Arvind, as he has secured another decade as an unofficial relationship manager for EPAM and Piper Sandler. Way to go, Arvind. Our next defendant in incompetence court, Ashwin Shirkavir of Citi, followed a similar pattern with a slight difference. Ashwin chased the stock up to the peak and chased it down, but to his credit, he was cautious at the top and decided not to go all in at that point. But unfortunately for him, in February of 2028, he caved into the peer pressure on the street and incompetently decided to go all in with a whopping 680 call when the stock was crashing and trading at 175. Ashwin. Bold? Yes. But your thesis was completely off base from reality. Like the others, Ashwin secured his position as the unofficial relationship manager for Citi and EPAM. As you can see, he never made a sell call. He did downgrade to neutral, probably because he was embarrassed about the timing of his whopping 288% overbid that likely bankrupted many people. Nonetheless, this behavior of maintaining buyer-neutral calls to appease their customers, the companies they are reporting on, is completely normal. Our next analyst, James Fawcett of Morgan Stanley, was previously convicted of incompetence, but he is getting a pardon today because after losing hope in June 2023, he changed his position to neutral and later questioned management in an earnings call in Q1 of 2024 and further corrected himself by changing to underweight. Way to go, James. You saw the light and did the right thing. It was a little late, but it's never too late to do the right thing. Also, as you can see, James started covering the stock in mid-2020 and thus was not negligent for an entire decade like all those other guys. Again, we give credit where credit is due. Good job, James. Our final culprit for the day, James Friedman of Susquehanna, also started his coverage later than the others, but he managed to destroy the incompetence meter with his performance. His call flow was a slightly less incompetent version of Ashwin's call flow as he chased the stock up, overbid after the crash only to chase it all the way down. His overbid of 710 at 521 was not as dramatic as Ashwin's whopping 288% overbid, and he quickly changed it, but still, comparing him to Ashwin doesn't say much. A 36% overbid after the stock has begun to crash is indeed a blatant display of incompetence. And to add insult to injury, his calls were bipolar at best in terms of the actual rating or recommendation given. He maintained a neutral to neutral positive the entire way, only to go all positive in his last rating after the stock's tank. The last call may turn out to be a good one as the stock may rebound, but either way, the overall ratings were all over the place.
Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on.
So the entire decade, most of the analysts covering EPAM basically played a game of chase with the stock, overbidding at the peak, and most of them maintained a cushy position as an unofficial relationship manager between EPAM and their firms, giving bogus ratings so as to not upset management. Gross incompetence, corruption at best, no public apologies, and this is being done by almost all the analysts on Wall Street. And the sad part is that the signs of EPAM's demise were screaming loud in the fundamentals of the company. EPAM Systems, founded in 1993, has evolved from a small software development firm into a major global player in the IT services and consulting industry. Headquartered in Philadelphia, the company has expanded its operations worldwide, providing services across various sectors, including financial services, healthcare, and technology. EPAM's growth has been fueled by strategic acquisitions and its reputation for high-quality service delivery. Since 2014, EPAM has faced a series of strategic and operational challenges. The company underwent significant management changes and strategic shifts that impacted its performance tremendously. Analysts often overlook these dynamics, focusing more on short-term market trends rather than the broader strategic picture. This oversight, coupled with broader market conditions, influenced EPAM's performance in ways that were not always apparent in the analysts' recommendations. The company's trajectory over the past decade reflects a complex interplay of growth, market pressures, and strategic decisions, with many of its key issues being missed or underestimated by those covering the stock. The COVID-19 pandemic presented both challenges and opportunities for EPAM Systems. At first, the pandemic caused operational disruptions, including shifts to remote work and supply chain issues. These disruptions led to short-term revenue pressures and project delays. However, the pandemic also accelerated the demand for digital transformation, which aligned well with EPAM's core competencies. As businesses sought remote work solutions and digital services, EPAM was well positioned to capitalize on these trends, although it faced challenges in scaling its remote workforce and adapting to readily changing client needs. After the initial impact of COVID-19, EPAM Systems faced a continued downturn that extended way beyond the pandemic's immediate effects. The company struggled with a series series of headwinds that hampered its recovery. Despite benefiting from increased demand for digital transformation services during the pandemic, EPAM encountered persistent issues. Heightened competition, rising costs, and operational efficiencies continuously plagued the company. The economic uncertainty and shifting market conditions that followed the pandemic exacerbated these challenges. Additionally, EPAM's attempts to adapt quickly to the changing landscape led to operational missteps and strategic misalignments. These difficulties were compounded by ongoing global supply chain disruptions and a complex labor market, further straining the company's performance. As a result, EPAM's stock struggled to regain its previous highs, reflecting a prolonged period of instability and declining investor confidence. The company's post-COVID downturn highlights difficulties in maintaining growth momentum and profitability amidst an evolving business environment. The EPAM situation offers valuable lessons for investors, particularly on understanding the importance of conducting an independent analysis rather than relying solely on Wall Street analysts. The pandemic exposed vulnerabilities in many companies, and EPAM's experience highlights the need for investors to dig deeper into the company's fundamentals, management quality, and industry trends. It also underscores the importance of paying attention to external factors like global pandemics, which can drastically alter a company's performance. Investors should focus on key performance indicators, financial metrics, and the broader economic environment to make more informed decisions. This brings us to a critical point. Sometimes being out of the noise on Wall Street helps us make more rational decisions when analyzing the above-mentioned matters. If you don't have the time to manage your own portfolio to make these analyses, you will likely be better off just dollar cost averaging into an index fund that is tied to the overall stock market. Professional investors seldom beat the market, and even listening to these incompetent quote-unquote experts on Wall Street will make it so that you have a hard time generating any positive return. So pick a strategy. Don't go at this blind. Either do a passive stock market fund dollar cost averaging approach, or take matters into your own hands and run your analysis yourself. But whichever path you choose, it's best that you use your time efficiently and separate your emotions when making your investment calls. Warren Buffett has been playing this game since way before most of us were even born. And there's a reason he lives in Omaha. Yes, I'm sure he loves his hometown, but he has mentioned many times that the distractions from being in the mix on Wall Street can destroy an investor. That, my friends, is why he stays where he is. When Warren Buffett talks about his investment style, he often mentions a moat of durable competitive advantage in the companies that he invests in. But today, I'm going to describe yet another moat that he has created. This second moat is called Omaha, Nebraska. Omaha is a very down-to-earth, laid-back place, and when you go there, you're surrounded by a serene sense of energy. More importantly, Omaha is 1,200 or so miles away from all the noise on Wall Street. So what can we take from this? Warren Buffett is arguably one of the best investors of all time. So let's try to learn from him as much as we can. When making important investment decisions, we should all set up an atmosphere and a serene environment that is far from all the noise on Wall Street. As we have proven and will continue to prove, that noise on Wall Street will only serve to lead you astray anyways. So get as far away from it as you can. Either put the time aside to learn accounting and financial statement analysis so you can do your own fundamental analysis, or just dollar cost average into an index fund that is tied to the market. But whichever path you choose to go down, make sure you minimize the noise and base your decisions off of logic and not emotion. Feel free to check out this video for a deep dive into another one of history's bloopers on this matter, Intel Corp.